This conference is being recorded.
Hello, this is Jim Steiker. Welcome to our webinar on ESOPs for mission-driven businesses. First of all, I'll note that we have enabled the chat function, so if folks have questions as they come along the way, please feel free to ask them. I'll try and take them as best I can. The agenda for the next hour, and we'll try and finish on time at 1:30 Eastern Time, is we're going to focus on ESOPs as they relate to liquidity and succession planning and alternatives, with a particular focus on how that looks and what the considerations are for companies that are very focused on mission, are often talking and thinking about double bottom line and other outcomes in addition to making money. And we'll talk specifically about how ESOPs work and try and illustrate how ESOP transactions happen. And probably briefly at the end, we'll talk just a touch about generally how to approach the whole problem of exit planning for a mission-driven company. We start out with the basic premise that all companies sooner or later are sold and transferred. None of us lives forever. All companies will have to deal with some sort of transition. The unique aspect of privately held companies is that there's no ready market. None of us can walk down the street to whoever happens to be owning the brokerage firm these days. I used to say Merrill Lynch. I'm not sure who they are right now. And sell our companies. We have to plan to do something. And particularly for mission-driven companies, we have no assurance that there will be a buyer who will both pay fair value and continue the mission-driven approach of the company. So our ability both to get fair value and continue what's often a multiple bottom line approach to operations depends on planning. And what we ought to do generally ought to be based on what shareholders are wanting and hoping to accomplish in the context of what are the potentially achievable alternatives. And of course, we look at what are the unique aspects of these kinds of companies. Typically, when we talk about a mission-driven firm, we're talking about a company that focuses on multiple bottom lines. It focuses certainly on earning money. And many times I've talked to companies that say basically making money is the key to making the mission happen. These companies often will focus on effects on the larger community, either in the nature of the product that they or service that they produce or deliver, or alternatively in simply how they do business, their effect on the environment, their effect on general sustainability, and so forth. Typically, we will see that key employees, and even more broadly employees generally, are in some form attracted to the business based on the commitment to the mission of the company or the approach and focus or culture of the company in addition to their compensation. In other words, employees have a little bit of a double bottom line in their approach to employment. And often there's some trade-offs of maximizing owner economic returns and employee compensation for mixtures of quality of work life and mission focus. And the challenge that a lot of these companies have is that when you look at the rest of the world, third-party buyers often are interested in buying the brand rather than the mission. In other words, they see a company that has a brand, and that brand may stand for some of the mission-driven behavior, and they like the brand. They like the fact that the brand has been well-positioned in the marketplace and attracts buyers, but it's not a commitment to the mission. It's a commitment to using the brand to make more money, and those buyers typically want to, quote-unquote, fix some of the uneconomic activity of the company to maximize profit as a buyer, while continuing the brand and some of the mission-driven identity, perhaps. Certainly, great example of this in the non-employee-owned realm is Ben & Jerry's, very mission-based company. Unilever did not buy Ben & Jerry's because They loved the things that Ben and Jerry believed in and had infused in their company. They bought it because Ben and Jerry's was a brand that sold a lot of ice cream, and they saw some of those things as a way to continue the value of the company, but again, they were buying the brand, not the mission. And of course, therefore, we've got more challenges for mission-driven companies in terms of liquidity and continuity, because we are not only going to evaluate what we might do from the point of view of dollars on the table and all of the ancillary tax and organizational pieces of that, we're also going to be looking at what's going to happen to the company from the point of view of continuity of mission. And what do people typically worry and focus on when they're in mission-driven companies, when they're thinking about liquidity and succession? Certainly, how much and how much do you get to keep? How do you maximize after-tax liquidity proceeds? For some folks, this is a last dollar approach. For some folks, this is merely a fair dollar approach. Very often, the founder or key entrepreneurs want to control the timing of succession and transfer. They want to remain involved. They see what they're doing as important both for themselves and for the company. They often want to try and bake in, if you will, socially responsible and mission-driven practices, have those things move on beyond the focus, interest, and control of the founder. Very often, one concern is to deter future liquidity events driven solely by economic gain. One of the things I hear a lot with people who want to sell their companies internally, particularly to employees, is that that's great, but they really want to make sure that 2 or 3 or 5 years later, employees don't turn around and say, now we'll take the full value of the brand rather than the mission and cash in and flip the company to somebody else. And of course, the guide words at the end of the day are some mixture of sustainability. How do we perpetuate ourselves as an independent, mission-driven company? And legacy. How do we sort of keep some of the other ideas and purposes of the company sort of to honor what's been done and created so far? And so with that, we can sort of look at the universe of what people can do with a company. And the world breaks down into external buyers, strategic buyers, people who see the company not as it is, but not as it might be. They're trying to leverage a brand. They're trying to leverage favorable cost structures, distribution networks, and so forth. Financial buyers who are simply buying the company for its cash flow, hoping to enhance that as they go along. The possibility of going public, taking the public's money. And we have the world of internal buyers, family, management, partners, or the possibility of employees acting through an ESOP. And finally, we have the last resort, which is what happens when the company is, if you will, worth more dead than alive, which is liquidation. And we're going to focus on the world of internal buyers because the world of external buyers for mission-driven companies is a troubling one. As we see, we have many examples of companies where the founders have done very well financially, but the new buyers, the external buyers, did not particularly have an overarching commitment to mission. They had a commitment to making money, and that's why they were willing to pay what they were willing to pay for the company. And when we look at internal buyers, internal buyouts are generally a way of using the company cash flows in one form or another by a purchaser to accomplish a purchase of stock from the existing shareholders. And we have lots of mechanisms and ways to do this. We can divert profit sharing or other compensation bonuses that would normally be paid to management or employees as part of the purchase price. We can simply agree to continue founder salaries, or we can deal with the more conventional world of leveraged purchases using borrowed money by family, management, or ESOPs, etc., to buy the company. And obviously we're going to talk particularly about how ESOP buyouts work, and we'll talk a little bit about why leveraged purchases simply by management or individuals or family don't work so well. And one of the things to think about from a conceptual point of view is the chart that's now in front of you, which basically illustrates what can happen to EBITDA in a company. And EBITDA is the conventional measure of cash flow that companies get to make decisions about: earnings before interest, taxes, depreciation, amortization. And the first and obvious thing we can do, left top quadrant, is put it back into the company in one way or another. We can make capital expenditures. We may require additional working capital. We can make acquisitions, and we can make other kinds of investments for continuation or growth. Research and development, hiring more salespeople, more development people, what have you. But it's putting money back into the company, not for today's return, but to earn money in the future, to succeed in the future. Second thing we can do, always quite popular on the top right-hand quadrant, is we can give cash to shareholders. We can take some of the money we have available and make it as a distribution to shareholders. And this, of course, can be as a distribution in an S corporation or a dividend in a C corporation. It can also be additional bonuses, fringe benefits, other things on behalf of shareholders. The bottom left-hand corner, often an unpopular idea, is that when we make money, the government expects us to pay a portion of that as taxes on the corporate income, either directly in the case of a C corporation or indirectly by having the shareholders pay taxes on corporate income in the case of an S corporation. But in one way or another, we're going to have to use some of our cash flow typically to pay taxes by either paying them directly or giving money to the shareholders to pay taxes. And finally, the fourth thing we can do with money in the realm that we're talking about today are capital share transactions. One shareholder or new group of shareholders taking cash flow of the company and using it to pay former shareholders or pay debt in connection with the purchase of shares from former shareholders to buy their stock. And one of the common things we hear is, let's sell the company either to management or a couple of individuals who are going to buy the company and have the greatest chance and likelihood of continuing the mission of the company. And of course, management is typically the most logical and motivated buyer. They know the most about it. They're usually there because they're already committed to the company. They're motivated because they don't like all of the other alternatives that might happen to the company. Chronic problem of management in looking at buying the company or any individual is they don't typically have a lot of cash. Very few companies have paid their key people enough money that those key people can turn around and make a cash or an all-cash or a significant cash offer for the company. So definitionally, a management buyout is usually going to be leveraged. We're going to borrow money to do it, and we're going to run into two basic problems when we do it. One is the effect of taxation, and the two is the dynamics of a change of control. And let's imagine, for example, take a simple example. Imagine we have a company that has $2 million of EBITDA. It's a solid, stable company, and for round numbers, we're going to assume we're going to value this company at 5 times EBITDA, or $10 million. So we have a $10 million value company. If we have a very, very highly motivated management group or even an investor, maybe they will, by mortgaging their houses, spouses, children, cars, whatever, come up with $1 million of equity. And that would be a very high-performing management group. And where does that leave them in a $10 million buyout? Leaves them $9 million short. And in today's environment, maybe we will be able to find $5 million, give or take, from a bank if we do very well. And that means that the seller is going to have to take back paper for $4 million, often a very unpopular idea. But the problem we have in paying back all of this debt is that if we're making a couple of $1 million, the government essentially is going to collect 40% of that in taxes. So therefore, the real cash that we have available after normal capital expenditures and after paying taxes, the real cash we have available to retire this $9 million of debt is probably going to be under $1 million a year. And so therefore, when we're paying interest on the debt already, that will probably be in excess of $500,000, it's going to take an awfully, awfully long time to retire the debt. And the reason is that we're basically having to earn money, pay taxes on it, and use the after-tax dollars to pay back the debt. And the second problem we have is that if we have a founder or owner who is taking back a large piece of the financing, what do they really want? They really want adult supervision. They really want to keep some degree of control over the company to make sure that things run properly, the company is run the way they expect it to be, the debt is repaid. And of course, from a management perspective, if they've put up, what for them is a lot of money and taken a lot of risk, what do they want? They really want to have control. They really want to be able to run the company according to their own dictates and processes. So management buyouts are often something discussed, very rarely happen as a result of this. And so we can do management buyouts as a non-leveraged basis. We can typically give management, bonuses or what have you, or offer management the chance to buy stock. Trouble is, it takes management way too long to buy enough stock to make a difference, and it's a very inefficient process for the same reasons. Management's got to get money, pay taxes on it, and then use that money to buy stock, and that tends to be a bit of a challenge. And so we get to the world of ESOPs, which we're now going to spend more time talking about. And now we're going to talk about a tax-efficient process, a shareholder-directed process where we can talk about how to preserve mission and be a mission-driven company. I'm going to talk somewhat about the downside of ESOPs, which is they are complex, involve lots of boxes and arrows and complicated tax planning. And the second downside is that they function in a regulated environment, which means that the government can look at this and want to make sure that things are done exactly appropriately according to a fairly rigorous set of rules and regulations. And so when we begin to talk about the ESOP approach, we'll start from the very beginning. What is an ESOP? An ESOP is an employee stock ownership plan. It is a qualified deferred compensation plan under ERISA and the Internal Revenue Code. When we say a plan is qualified, we simply mean that the employer, the company, can make contributions to the plan on behalf of employees and take a tax deduction for doing that. But employees who are receiving the benefit of the contributions do not have to recognize taxable income until they take distributions from the plan at a later date. And the price of doing this is complying with a whole set of rules and regulations to make sure that the benefit is broadly available to a broad group of employees. ESOPs are unique as qualified plans from other kinds of plans in two primary ways. I mean, they look generally like profit sharing and 401k plans, but ESOPs must invest primarily in company stock. In other words, they're not intended to be a diversified plan. They're intended to be a focused investment in company stock. And unlike all other kinds of plans, they can be leveraged. They can borrow money. So an ESOP can borrow money now to buy a block of company stock and use future company contributions and future earnings to pay back that debt. So that's how ESOPs can get a significant block of company stock. Why do people enter into a conversation about ESOPs? When does it come up? First, it comes up generally in the context of liquidity. What am I going to do with my ownership in a closely held company? What am I going to do to make sure I get fair value for some of the things that have been created? How am I going to perpetuate the company? Secondly, ESOPs come up in a conversation around tax planning. It's a very efficient mechanism to transfer ownership of the company. Thirdly, ESOPs come up for mission-driven companies because it's a mission most likely to have interest, ability, and focus in continuing the mission-driven behavior of the company, and continuing a double bottom line ideology, and continuing to focus on the things related to the products, services, or behavior of the company that matter. Secondly, ESOP transactions, because they typically are not take place in a single moment of time with all of the dollars changing hand in one moment, have a lot of ability to provide for some extended control or restrictions having to do with the founder to make sure that the mission is preserved of the company and that the founders continue to exercise some degree of control over the company for a good period of time. So that's why ESOPs tend to come up in a discussion for mission-driven companies. So our typical goals of ESOP transactions generally are liquidity, succession, tax planning, and an ownership incentive for employees. Those are the generic goals of almost all ESOP transactions, whether they're in a mission-driven company or in the most conventional of companies. And what are the tax benefits that typically motivate people to think about ESOPs? The most important tax preference for ESOP companies is the ability of the company to fund the purchase of stock from shareholders using tax-deductible dollars. This takes place, we'll illustrate this in pictures in a minute, but it takes place by the fact that we can borrow money to pay for stock that we're going to buy from a shareholder and effectively fund that repayment with pre-tax rather than after-tax dollars. Second opportunity is the opportunity in companies that are or become C corporations for shareholders who sell to an ESOP to defer capital gains tax on the sale indefinitely. We'll talk about that in a minute. Third key tax preference is the ability of an ESOP company to pay a dividend either to help pay down the debt for an ESOP transaction or to give to employees in cash in a C corporation and to get a tax deduction for paying that dividend, unlike conventional dividends. And the fourth key preference, which we'll talk about in a minute, is the ability for companies that are or become S corporations, pass-through entities, to get to the point where the income that the company earns is attributed to a shareholder, the ESOP, where the shareholder doesn't pay current taxes on that income. We'll talk about that in a minute. By the way, again, I'm going to urge people, if you have questions, please put them into the chat, and we'll try and address them as we go. Let's talk about capital gains deferral for a minute. Basically, under Section 1042 of the Code, coincidentally not far from Section 1031, which deals with like-kind exchanges, lets people who sell to an ESOP have a variation of a like-kind exchange. It permits a shareholder who sells stock to an ESOP to indefinitely defer capital gains tax on that sale of shares to the ESOP if the company is a C corporation on the date of the sale. Doesn't matter, by the way, if you become an S corporation a day later, but if you are a C corporation, you can defer capital gains tax on a sale of shares to the ESOP if you meet a couple of conditions. First of all, the ESOP has to own, at the end of the day, 30% of the value of all company stocks, so we need to have at least 30% ESOP ownership. And secondly, the selling shareholders who do this need to purchase what we call qualified replacement property, QRP, which can be stocks or bonds of any domestic operating corporation. So typically, shareholders are able to basically exchange the stock they own in a closely held company, get cash, and go out and buy a diversified portfolio of stocks and bonds without at all paying the toll keeper, paying the tax man any portion of that as capital gains tax. And of course, this is important now with a 15% federal rate, which means it's not overly motivating people, but particularly in states that have high tax state rates, such as New York and California, it's still a significant deferral. And of course, with the prospect of a new administration and perhaps higher capital gains rates, this may become even more important for a lot of the companies that we speak with. So that's capital gains deferral. We then get to the benefit for S corporation ESOPs, which is in an S corporation, as we know, corporate income is for tax purposes attributed to the shareholders of the corporation. The ESOP, as an S corporation shareholder, pays no taxes on its share of corporate income. So if we have a company, for instance, that is 100% owned by an ESOP, and the company is or elects to be taxed as an S corporation, then we have created a company that will operate effectively as tax-free as the United Way, because there will be no corporate level tax on the corporation's taxable income, and we have a shareholder who will not pay any current taxes on the corporation's income. So we have the use of 100% of our EBITDA for other corporate purposes other than paying taxes. This, of course, is a remarkable tax break and the motivator for a lot of companies to look at ESOPs more carefully, and the motivator for a lot of companies with partial ESOP ownership to consider becoming fully ESOP owned. Downside of S corporation ESOPs: if we are and remain an S corporation, our shareholders, when they sell to the ESOP, do not get the benefit of capital gains deferral under Section 1042. I'm going to pause for a minute and see if there are any questions here. Anybody wants to type anything in here? So having no questions, we will move on and talk a little bit about how ESOPs work, what the mechanical process is. And we'll do it first in words and then probably more useful in pictures, and we'll talk about how ESOP transactions actually function. And of course, the first thing we have to do is we have to create the ESOP, which is a trust for the benefit of employees. We have to have a plan document and a trust, and we have to create the trust for the benefit of employees. That trust is going to purchase company stock, typically from shareholders, possibly from the company. The financing for the transaction is typically going to come from the bank, perhaps from the seller in part or in whole in some situations. The company, on an ongoing basis, is going to pay contributions or pay dividends to the ESOP that the ESOP uses to repay this kind of acquisition debt. And of course, down the road, the company or the ESOP will have to buy back shares from employees after termination in order to help fund what we often call repurchase obligations on behalf of employees. So let's look at a typical C corporation ESOP transaction. Let's again imagine our company with a $2 million EBITDA and a $10 million enterprise value. And first question is, how do we know what it's worth? And the answer is, in every ESOP transaction, at some point the ESOP is required to have on its behalf an independent appraisal of the value of company stock that it's going to purchase, or it's going to do, or it's going to sell for that matter. And so ESOPs are not Priceline. We don't get to name our own price. We are going to have an independent appraisal on behalf of the ESOP. And so we'll imagine our appraiser has somehow indicated, or we've proposed to the appraiser, and they have agreed that the company is worth somewhere in the neighborhood of $10 million. And so in that example, we have shareholders, and the typical profile here is going to be a minority interest transaction. And our typical profile here are shareholders who say, we'd like to take some cash out of the company favorably. We'd like to provide some ongoing incentive, reward, connection, involvement for employees. What we're going to do is we're going to sell part of the company, a minority interest, to the ESOP, so that the ESOP will become part owners of the company, the employees will become part owners of the company, and we will take some chips off the table. This is often a profile for business owners between 45 and 60, let's say, although some older, some younger. And the idea is to share ownership broadly, diversify. And so let us imagine, for the sake of argument, that in our $10 million company, the shareholders decide, gee, we'd like to have a $4 million liquidity event. We want to take $4 million out. We will still own the remainder of the company. And they'll go to the bank, typically, and say, bank, we'd like to borrow $4 million. And what does the bank want back? The bank wants back, first, the promise to pay it back and a belief that you have the ability to pay it back. And secondly, they want collateral, things that they can grab if you don't. Now, if we are a debt-free company, and I'll use that for my example here, borrowing $4 million based on a $2 million EBITDA, it's not going to be too difficult to trick. The bank's going to most likely or certainly conclude that you'll be able to pay them back and that you're not going to be too highly leveraged. The bigger challenge may be collateral. If we're a manufacturing company or an asset-rich company, finding collateral to give to the bank will be relatively easy most of the time. The bank will take a lien on assets, buildings, machinery, and equipment, and the like. However, what happens if we're a service company? What happens if we're a company like my company where all of the assets, as some people say, walk out the door at night, and if you took all of the nice desk chairs, computers, and what have you, you might get a little bit of money if you put it out on the street in a yard sale, but nothing approaching $4 million. And that, of course, describes a lot of our clients, and I want you to bookmark that question because we'll answer that in a minute. But now we have a company that's gone and borrowed $4 million, and so it now has $4 million of cash and a $4 million liability to the bank. So far, we haven't done any damage to the balance sheet. We've added cash and we've added a corresponding liability. So the company is going to take the $4 million, in my example here, and turn around and lend it to the ESOP. And that's going to be a loan. And the ESOP, of course, is going to give back a note. It's promised to pay back that loan, and also a pledge of the stock it's going to buy with the proceeds. And now we do have to note we have done damage to the company's balance sheet. Why is that? We've taken $4 million of cash off the balance sheet that we borrowed. We still have the liability to the bank. And we'd like to think of the note payable by the ESOP as a loan receivable, which of course would be balance sheet neutral. But Standard Accounting Procedure 93-6 tells us that when we're lending the money to an internal entity, like an ESOP, we have to account for the note receivable we get back, not as an asset, but as a contra equity account. So what we've really done now is created some damage to the equity section of the balance sheet. Do we care? 99% of the time we don't. The only people typically looking at balance sheets from a formal purpose are the bank, who will already understand us. And so unless we are a company that depends on other entities for creditor review, and these would be things like construction companies perhaps that have bonding requirements, or some kinds of distributors where the manufacturers have some balance sheet restrictions. Most of the time this will not matter. So our ESOP now has $4 million of cash and owes the company $4 million, and it's going to turn around and buy $4 million of stock from the shareholders. It's going to deliver the cash to the shareholders, and the shareholders are going to deliver stock to the ESOP. Now, my trick question, if we were live here in front of people, is how much stock does the ESOP get? And most people's intuitive math says, well, the company's worth $10 million, and we just sold $4 million, so therefore the ESOP ought to be getting 40% of the equity. Our problem here is that we know the company may be worth $10 million on an enterprise basis, but this is a case where the parts may be worth less than the whole if we're not careful. An independent appraiser looking at a minority interest of company stock might readily conclude that we really ought to be applying something in the order of a 20% discount for a minority interest, and that the ESOP for its $4 million ought to be getting not 40% of the company, but maybe 49.5% of the company. How are most entrepreneurs going to feel about this? Not very good. Why would you give up? Why would you sell your companies in pieces where the pieces don't add up to the whole? And our workaround here, typically in a C corporation, and one of the reasons we want to be a C corporation for most minority interest transactions, is we're going to have the shareholders sell the ESOP, not ordinary common stock, but a dividend-paying stock. And why does that matter? Well, we said before that dividends paid by a company to an ESOP tax deductible. We know that we're going to have to give the ESOP money, and you'll see this, by the way, in the next slide here, we know that the way this loan is going to get repaid is the company is going to give money to the ESOP, and the ESOP is going to pay it back to the company. We're a little bit indifferent as to whether that money we give to the ESOP is a contribution or a dividend, because both are tax deductible. However, as we go backward to our prior slide, we know that if the ESOP is getting a special dividend, our independent appraiser is likely to tell us that we can pay more for the stock than if it was merely ordinary common stock. And so very often the dividend preference that the ESOP is getting will offset the negative effect of the minority discount, and our ESOP will effectively buy 40% of the company for $4 million in our $10 million value company. So our shareholders in this example now have $4 million of cash. And ordinarily, if we sold our stock, the shareholders sold stock to any of the people on this call individually, they would have to pay capital gains on that. Typically, a federal rate today of 15% plus whatever the state rate might be. However, as we talked before, under Section 1042, since we are a C corporation, have become one, and we've sold more than 30% of the stock to the ESOP, if we go out and buy stocks or bonds of any domestic operating corporation with our $4 million, we can indefinitely defer capital gains taxes on the transaction by the purchase of QRP. And that QRP is also the answer to the question of how the bank might lend us $4 million if we don't have $4 million of hard assets. And the reason is that the bank may look at the shareholders and say, you're buying these securities as a long-term investment. Give us a lien or pledge of some of these securities as additional collateral. How big will that pledge be? That really depends on the credit quality of the company, the credit environment, the bank's focus. The answer is somewhere between 0 and 100%. And of course, in an ESOP transaction, how big the pledge of QRP might be is much more highly negotiated, perhaps sometimes, than the actual lending rate. Any questions so far? Again, please type your questions in if you have any. So in paying back the loan, and if we've borrowed $4 million, let's say over a 7-year term, we know we're going to be paying annual principal payments of about $570,000. We know we're going to be paying interest in the current environment somewhere around $250,000, and we know when the company pays the bank, the $250,000 of interest is tax deductible. The $570,000 of principal directly is not. However, at the same time, the company is going to hand to the ESOP, not coincidentally, 570 plus 250,000 in my example, or 820,000. But the ESOP is, and it looks like the money's leaving the house twice, paying both the bank and the ESOP. But the ESOP doesn't even cash the check. This is really a paper transaction where the ESOP will turn around and pay back to the company 570 of interest, 570 of principal, 250 of interest. Net result, of course, here is in this top transaction between the company and ESOP, company's gotten a tax deduction for the entire amount of the contribution and dividend, but some of the money has come back to the company as a non-taxable return of principal. So the company has gained in that non-cash loop a tax deduction equivalent to the cash non-deductible principal payment to the bank. This is why we say principal is effectively tax deductible in an ESOP loan. And the result for the benefit of employees is we purchased a block of stock, $4 million block of stock, but on day one we owed the company $4 million, so all of that stock was encumbered, and now basically 1/7 of that stock has been paid for. So we've now released that and allocated that for the benefit of employees. So we'll go on and now and look a little bit at S corporation transactions. And here often the goal is to get 100% ownership to the ESOP so that we can operate it on as a tax-free entity. We're not so focused on capital gains deferral. Again, we're going to borrow money from the bank to fund this perhaps to the best of our ability. Only this time, given that we don't have capital gains deferral, we don't need to have the ESOP buy stock from shareholders. And the second reason in the other transaction we had the ESOP buying stock from shareholders is we needed tax deductions to shield the payment of principal. And here, since we're going to be 100% owned by an ESOP in my example, we do not need tax deductions. So really what we're going to do here is we're going to take whatever cash we borrow and we're going to redeem all of the stock from the shareholders, probably have the company buy most or all of it, in exchange for that cash with the payment of the balance in a subordinated note. So if we borrowed $4 million in the value of from the bank and the value of the company was $10 million, we're going to hand the shareholders $4 million of cash and a $6 million subordinated note. First and basic question is, why would a shareholder take a subordinated note? Most any financial advisor will tell you selling your company for a note isn't a terribly good idea. But the reason they tell you that is because typically the note you receive doesn't really have the same economic value as the cash. It's typically a low interest rate, low level of security. Here we're going to price the subordinated note payable to the shareholders as though it is what it is, a true subordinated mezzanine debt. And if you look at it in the marketplace, what do mezzanine lenders expect to receive as a rate of return for lending subordinated debt? Typically 12, 15, 18%. So we're going to try and get the shareholders that level of return. Of course, we can't do that by paying cash interest on an ongoing basis. That'd probably be more than the company could afford. So typically what we're going to do is give shareholders a lower rate of cash interest, which is ordinary income, and a high level of warrants. Warrants being a right to buy stock in the future at a low value set today, which are going to provide the rest of the economic return, because we know as we pay back debt, companies should grow in value. And warrants, for the most part, create capital gains rather than ordinary income. It's based on the appreciation in the value of company stock. Typically, it's paid out as a cash payment by the company to the shareholder at a future date. And so what we're trying to do is give the shareholders a piece of the upside of the company, in part return for taking a note back for some of the stock. So typically the warrant position here might, for example, be 20% of the increase in value of the company. So the shareholder is getting a note for the principal amount, some current interest, and a right to 20% of the upside of the company. And so that's why a shareholder might consider taking a subordinated note, because they're going to get a high level of return on it. Second reason is we can attach to that subordinated note some other terms and conditions. We can attach some governance rights. For instance, the ability of the selling shareholder here to pretty much control who can be on the board of directors and how the company will be run, at least while the note is outstanding. And so this is a way a shareholder can sell the company and make sure that they have a great deal of say in how the company is run, have a great deal of say in continuing the mission and operation of the company. And of course, having done these transactions, the ESOP is going to buy newly issued shares from the company, typically for a nominal amount of money, because our $10 million company now has $10 million of debt, but the ESOP becomes the 100% shareholder of the company. And so on a go-forward basis, when the company makes money and it's profitable, the taxable income attributed to the ESOP doesn't pay any taxes. Company has 100% of its cash flow available for the mixture of growing the company, paying off this debt, and so forth. So a typical vision in an ESOP transaction, and based on the first transaction, it will sell the company in one or more capital gains deferral transactions to eventually get most or all of the stock ownership to the ESOP. We'll do it over time. And eventually we'll give stock options or phantom stock equity or stock appreciation rights to key management to allow key executives to have a significant stake in the company outside of the ESOP, and eventually we will make an S corporation election. And that's one pretty common pathway, sell the company in pieces. Second common pathway, to do it all in one fell swoop, have the S corporation redeem all of the stock for cash and subordinated notes. Again, give out warrants in connection with the subordinated notes so that the founders typically retain 15, 20, 25% of the upside of the company. Use stock options, phantom stock, or other devices for key executives to allow key people to have some ownership outside of the ESOP, and have the company use its now tax-free operational ability for being an S Corp to accelerate the repayment of debt in these circumstances. Again, any questions here? People want to type them in. So transaction concerns in getting this done. Valuation, what's the company worth? Will an independent appraiser see the company the way we do? Financing, the effect of the ESOP on the overall benefit structure. Legal and fiduciary risk, we want to make sure the company this transaction is properly designed to minimize risk. And of course, finally, managing cost and complexity. We want to make sure it makes sense to do and isn't overly complex relative to the company. Valuation, of course, we have to have it done by an independent appraiser. It's generally key to expected cash flows, done from the perspective of a financial buyer, somebody who's going to continue the company as it is rather than do new and wildly different things. We look to see whether the ESOP's buying a minority or control of the company. We're going to have a marketability discount, perhaps, small one, but the ESOP does have a put option. We may use dividend-paying stock. And of course, we have a trade-off between value that we want to get now and future restrictions we want to place on the company later. Got one question here is asking that we need to buy at least 30%, and it says less than 50% to get the benefits of a C corporation transaction. The answer to that question is that it's half right. In order to get capital gains deferral, we need to have at least a 30% transaction, but it can be up to 100% transaction. We can do it as a C corp initially and become perhaps an S corporation later. So, back of the envelope valuations are to look at EBITDA, earnings before interest, tax, depreciation, amort, subtract outstanding debt, add the value of the assets that we don't use in the business, like cash value of life insurance, and then look for an appropriate multiple of that EBITDA to calculate the value. Question we have also asked, in an S corporation, shareholders pay taxes on company earnings. The ESOP trust is a tax-exempt trust. It does not pay taxes on the earnings currently. And so that's why, unlike a conventional S corporation, we don't have to get the ESOP cash in order for it to pay taxes. The way taxes get paid in an S corporation ESOP is that employees pay taxes when they receive a distribution from the ESOP based on the value of their stock. Of course, they can roll over that. They can avoid taxes even then by rolling over the distribution to an IRA. But the magic here, of course, is that the ESOP is a tax-free entity. Our next question, I'm taking them as I go here. Banks still financing ESOPs, and what do we think about the credit crunch? The answer is I've closed 2 bank-financed ESOPs this week. So at least this week I can vouch for the fact that banks are financing ESOPs. The credit crunches we're seeing it for middle market companies so far is a tightening of lending standards, where banks used to be loaning 3 to 4 times EBITDA, and we're right now into the next slide here. Now the banks are much more comfortable at 2.5 times EBITDA. They're, of course, much more focused on collateral. I don't see middle market lending going away unless we go way, way deeper into a credit freeze-up or a crunch. So I'm not too worried about financing our garden variety ESOP transactions, albeit the financing will be less favorable than it would have been, let's say, 18 months ago. Other question I'm answering as we go here, is it more tax efficient for ESOP shareholders to have a C Corp when doing an ESOP? And the answer is, like most questions, it depends. If we're looking at selling a minority interest, most of the time, not all of the time, most of the time it will make sense to consider being a C corporation to sell a minority interest to the ESOP. If we're selling the entire company, if we are an S corporation already, most of the time it will not make sense to become a C corporation. We'll want to stay an S corporation. If we are a C corporation and we're selling 100%, we'll want to stay a C corporation, sell 100%, and immediately after, very often become an S corporation. ESOP financing, as we said, it's really been tightening up a fair bit here. Debt to EBITDA currently much closer to 2.5 to 1 rather than the 3.5 we used to see. Not a whole lot of air balls out there. Rates have come up. They're typically pegged to LIBOR, 3-month LIBOR, by the way, not overnight LIBOR, which has been spiking a bit. And it's typically a margin of 150 to 300 basis points over LIBOR. LIBOR is at around 3-something, 3 or so today. So you can calculate your rates on that. Air balls are the idea of loaning money that is more than the collateral will support. In other words, if we want to borrow $4 million and we have $3 million, we're asking what bankers would call take $1 million air ball, which is to say a piece of the loan not supported by collateral. And if we can show that we can pay back that piece of airball, that piece in addition to the collateral, within 12 to 18 months, very often we can get a bank to do it, although that's tending to tighten up a little bit right now. Where are we going to get the money from? Banks, mostly the relationships we have, commercial banks. Brokerage houses have been in the business of lending money, although they're starting to get out of it. We may have seller financing, and for some highly complex deals, we might be looking at some of the specialty finance groups. We have a question, what happens when participating employees leave the company? And the answer is we have to turn their stock into cash. We call that in an ESOP company the repurchase obligation, the obligation to cash employees out. We're going to cover on our next slide ESOP plan design issues. Let me focus on bullet 4 here, which is benefit distributions, which is to say when people leave the company, what do they get? And the answer is that typically the legal maximums are that if they're leaving for death, disability, or normal retirement after age 65, typically we must begin to pay people out the value of their stock, funded by the company, beginning a year after those events, but we can pay them out over a 5-year period. If people leave for any other reason, pre-retirement, go fishing, work for a competitor, go work somewhere else, do all the things that people might do, we can make people wait for 5 years and then pay them out over a 5-year period. What does this mean practically? It means that it takes a while before people are going to leave the company entitled to receive a distribution, and it's going to take a while before those distributions are meaningful. Why do I say it's going to take a while? In order for people to be entitled to something, they have to be in the plan, eligibility. They have to get allocations of stock over time. As we saw before in our earlier discussion, we don't allocate the stock all at once. We allocate it as the loan is repaid. And they have to meet a vesting schedule, typically a 6-year vesting schedule. So as a practical matter, repurchase obligations will typically take about 10 to 15 years to become moderately significant. And that's usually well after the lifetime of the initial leverage. So we will again have more cash flow to deal with it. So eligibility in an ESOP, typically all employees who work more than half-time will be eligible. We can make people work for a year before they become eligible. Once they are in the plan, they will participate each year so long as they work 1,000 hours during the year and are employed on the last day of the year. Allocations of stock that the ESOP is allocating are typically made at the end of each year to all eligible employees. Most typically they are made in proportion to the relative compensation of plan participants. Therefore, if I make $20,000 and somebody else makes $100,000, they will get 5 times as much stock as I get. We can use flatter allocation systems, perhaps factoring in service and making them more flat. We cannot skew the allocations more than based on compensation to higher compensated employees. Vesting is the period of time we've got to work in order to receive a benefit under the ESOP, and typically vesting schedules are either 2 to 6 year scaled schedules, 20% vesting after 2 years, 40 after 3, 60 after 4, 80% vesting after 5, 100% vesting after 6 years, or 3-year cliff vesting, no vesting for 3 years, 100% after 3 years. We talked about distributions. A couple of questions we have, again, taking them as we go. Do shareholders usually get less value from the ESOP than selling to outside investors? The answer is sometimes. If the outside investors are strategic investors, i.e. other people who are going to combine your operation with their operation, strategic investors can often pay a strategic premium because they may be consolidating back office, gaining other strategic advantages, and so typically you'll get more value from selling to somebody who will pay a premium to combine what you do with what they do. On the other hand, private equity firms and other kinds of financial investors typically ought to be paying about the same price that the ESOP is paying. Next question, do all employees have to participate or can you pick and choose? The answer is all employees have to participate generally. This is the price of the tax benefits are meeting the ERISA broad involvement requirements here. I'm going to skip on a little bit of the rest of this. We can talk offline with anybody who's interested about how voting works, how trustees work in ESOPs. Basic steps here in the transaction process. Feasibility study, figure out what's going to happen. How can we optimize the outcome of an ESOP transaction? Does it make sense? And then we're going to deal with financing the transaction, the appraisal process, the plan design process, the legal documents to get to a closing. We do have an IRS approval of our plan document, but they don't generally look at the transaction except on audits. On an ongoing basis, what we have to do, we have to update our appraisal annually. We have to keep annual record keeping and administration. We do have to eventually deal with repurchase obligations. We have to think about how we're going to communicate to people, and we have to, of course, deal ultimately with ongoing legal compliance. The government does change the law on us every once in a while. Last few slides here, I'm not going to walk through. Hopefully you'll have a chance to read them, but the focus here is much better to focus up in advance on what you want to have happen and what you want to do, rather than to let the process of liquidity and succession happen to you. Last question I've got here, what the implications of employees' compensation are their out-of-pocket contribution. Typically, ESOPs are a company-funded benefit. It is difficult but not impossible to look and ask employees to contribute or use 401k money. We typically don't advise that. It's typically a new company benefit. Sometimes there will be a trade-off on existing benefits. For instance, perhaps we will have a lower match in the 401k, or perhaps we will have a lower bonus program. But these are all company-driven decisions. There's no one single answer. I'm going to unmute for a minute. Ask if there are any
The
Final
conference
questions
has
here.
been unmuted.
So if anybody has any questions they want to ask with the group on the phone, go ahead, and then we will conclude on time.
In a leverage, hello?
Yeah?
In a leverage situation, if the shareholders sell more than or 30% or more to the ESOP, and they buy shares in another company, do they have to hold on to those shares that they purchased until they retire at 65?
They basically if they buy qualified replacement property, they have basically transferred their basis from the shares they sold to the ESOP to the new shares that they have, new investments that they have made. And whenever they sell those investments to selling shareholders, they'll recognize capital gains tax then. There are a number of strategies out there, and we could talk about that offline in more detail, where the goal is never to recognize the capital gain, to have it pass eventually into an estate where you get a step up in basis, and therefore have avoided the capital gains permanently.
Thank you.
Anybody else? I want to thank everybody for listening and participating with your questions. I think we'll have this the slides are readily available. And feel free to contact us if you have further questions or you want to talk a little bit more about any of this offline. So thank you for participating. Bye-bye.
Premiumbeat.com